Hi there, thanks for tuning in. Today, we'll be doing an analysis and valuation of Fresenius Medical Care AG. Fresenius is a company that does care and sells products related to everything kidney disease. Basically, if you have a problem with your kidneys, it's more likely than not that you will be receiving services or using products from Fresenius. So, their revenue development in their quarter 3 2023 is driven by basically foreign currency translation. That's not a big deal, but in-center disposables, machines for chronic treatment, and home hemodialysis products, and of course the services they provide, either services to those machines, services to people, etc. And earnings have improved year over year, basically driven by increased volumes, offsetting cost inflation, and then currency translation effects. So it's important because everyone is going to know someone at some point who deals with something related to their kidney. It's unfortunately a very common problem, and Fresenius is in that field, right? Trying to deal with it, trying to help patients for that. Now, they're a company that has strong free cash flow, which is great. I love companies with positive free cash flow, and not just positive but growing and strong. So their free cash flow in this latest quarter compared to the last quarter grew by a significant amount, which is pretty great. And even though their capital expenditures grew as well, overall, or rather the investing activities grew as well, the overall bottom line for the free cash flow is still positive and growing. They also are a company with quite a little bit of leverage. Their net debt to EBITDA is in the 3.4 range. They have that target corridor there, as you see, that is 3 to 3.5 times. That's a little more than I'm personally comfortable with. They are a company that wants to do that, and they do refinance their bonds to have very favorable terms and have very long-term debt with favorable terms. That is the bonus of being like a larger company. However, what I would say is that in the case of bankruptcy, if you have a very leveraged company, all of it is going to go to pay off the bondholders and the debt holders, and then if anything is left over, that goes to the stockholders, right? So if you're a stockholder here and Fresenius managed to go bankrupt in a worst case scenario, you probably wouldn't get anything in return if they're this leveraged. So that's just something to keep in mind. Now, they also upgraded their earnings guidance. Basically, revenue is going to grow by low to mid single digits, and then operating income is going to grow by low single digits. And then by 2025, an improved operating income margin of 10 to 14% is targeted, which is good because their operating margins have been suffering a little. Now, this shows basically where their patients or where all the people they're serving come from, right? So it's patients with chronic kidney failure, and this is unfortunately a growing number, right? This can be for many reasons. Among it, that simply the world population is growing, and it is also aging. So an aging and growing world population will have more cases of kidney failure. This is unfortunate, but this is something that's happening. So they have way more patients than before, right? It even grew from last year to this year as they reach more patients and as more people age and unfortunately suffer from these things. They also have their healthcare product revenue. So hemodialysis products, peritoneal dialysis products, they basically are giving them some revenues that has grown basically from 2020 to 2022 a little bit. However, most of their revenues are not from these healthcare products, but from the healthcare services they provide. Now, both of those have a top line that is growing, right? Their healthcare services has grown from 2020 all the way to 2022. Their healthcare products has grown as well, which is great. Now, their cost of revenue is a little bit, and you see here that the margins are still somewhat okay. In gross profit, the margins have sort of stayed a little consistent, maybe not perfect, but as revenue increases, the gross profit generally increases. However, when you go to operating income, you see here that OPEX has been going down, even though revenue is going up. So what is up with that? Well, basically, it seems like they have these monster selling general and administrative expenses that are growing. So that can be the sign of a company that is maybe not the best run or maybe not the most efficiently run, right? So That's important. The operating expenses are their fixed costs. So in the future, what will their selling general and administrative expenses look like, right? What would all these fixed costs look like? And in a bad year, will a bad year be even worse for them because all of a sudden they have more fixed costs to take care of now? It's interesting, and it's something to note. There's pressure on margins, and that translates all the way down to net income, where you see it decreasing even though revenue is increasing, right? Now, this is not inherently a bad thing, obviously. If there's more research and development, if there's more marketing and stuff like that to acquire new clients, new patients, then you'll see that money return eventually. However, this can be a sign of worry, the compressing margins. Another sign of worry is the return on invested capital, which continue to be impacted by lower earnings. Basically, return on invested capital shows you how much of shareholders' money will be returned by how many dollars that come in will generate how much in profits, right? So this, let's take this 8% that you could see around 2018 and 2019, right? So if I invested $1, right, into this company, into Fresenius, essentially I would get 8 cents of profit. Fresenius would generate 8 cents of profit for every dollar invested in it. Now, that is at an adjusted rate closer to 3.2%. Now, clearly, there's a lot of things that have impacted Fresenius. Everything over here listed has impacted it. But they do list a bunch of stuff here, like, for example, the effects of hyperinflation in Turkey and impacts related to the war in Ukraine, which, okay. But at the same time, what here is mismanagement? What here is making this almost unstoppable trend since basically 2017 or 2018, right? That's the important question to ask, and this is the subject of concern. If this trend does not change, it shows that with the compressing margins, that Fresenius is being less efficient, right? Or management is being less of a smooth machine, right? So, with that said, I'm going to do a discounted cash flow model using free cash flow for equity and free cash flow to equity. And I am going to basically say Fresenius is going to grow in 2023 and 2024 at a rate of around 3.5%, right? And then in 2025 and 26, it's going to grow 2%, and in perpetuity, right? I have a required rate of return of 11%. Then I have a perpetual growth rate of 2%, so that's going to grow in perpetuity for 2%, divided by the total number of shares, and I get a fair value of equity of $63.47. However, once we discount the net debt, which, as I was saying before, they have a lot of debt, so we have to account for that, then the value goes lower, and the fair value post-debt is of $19.94. Now, where's Fresenius stock right now? Let's take a look. So, if you see, this is actually lower than the price I had for the discounted cash flow. And you'll also see that in the last 5 years, Fresenius wasn't necessarily an overachiever. It was more of an underperformer, going neither here nor there. Maybe you could have taken advantage here in the COVID dip and up here, but it just was kind of going nowhere. Now they took a gigantic tumble, and that's very important to note. This latest tumble, right, from a level of mid-20s down to 17.44 as of November 3rd, is explained by this. Ozempic is that drug created by Novo Nordisk, which is apparently a miracle drug because it has apparently helped people with kidney trauma. It also reduces appetite. So a bunch of stocks went down related to Ozempic, right? Every food stock went down, every fast food stock at least, because all of a sudden, if people have less appetite, then they won't necessarily need to eat. If people have less appetite, a bunch of diabetes medications probably will be affected, etc., etc., etc. Now, basically, the Ozempic effect was very pronounced for a little bit, but at the same time, this is a medical trial still. The medical trial was very successful, but at the same time, we also don't know all the side effects yet. It's still in trial phase. It's not rolled out. Social anxiety can increase, apparently. There's more dangerous side effects, allegedly, right? Will it change the world completely? I don't know, right? But this may be a little bit of a panic, especially when Fresenius said that drugs like Ozempic, the effect of drugs like Ozempic on patient numbers is neutral, right? At the end of the day, some patients may go, but at the end of the day, if it slows down the effect of kidney trauma, they will still need Fresenius services and products, right, to deal with it, even if it slows down or helps them manage it, right? And at the end of the day, again, a growing world population and an aging population will still see more patients overall. And likewise, even though Fresenius sank, I will say that maybe these fears are overblown. So what to do? Well, Fresenius looks slightly undervalued according to my discounted cash flow model. However, the company is not really devoid of risk. Ozempic may be an overstated risk, but I think the fundamental troubles may be understated. So the high level of leverage and the pressure of margins and return on invested capital is something to keep note of. The story of Fresenius then changes into a stock that's just fundamentally sound and maybe underrated into somewhat of a comeback story. Because what's important here is that the margins can come back and that the return on invested capital can improve, right? So it's all going to depend on execution. And at the end of the day here, what matters is your risk tolerance, right? If you have high risk tolerance, and Fresenius looks like something where you would say, okay, I can deal with some long-term pain, but I think fundamentally they're too sound, they'll recover, they'll do good, then this stock may be for you. If not, it's great to look elsewhere, right? And it's not like they're not a great stock in some ways. Again, growing revenue, right? Great top line, solid free cash flow. And because they're not necessarily a pharma stock per se, they don't have to deal with like all these different drugs and getting them approved and testing them and the pipeline and the patents, right? So this is another inherent strength of Fresenius. So it has inherent strengths and weaknesses, just like many other companies. So it will all depend on your risk appetite at the end of the day. Now, with that said, I hope you found this video useful. Thank you very much for watching. If there's any stock you want me to cover, feel free to comment down below. With that said, thank you so much. Don't forget to like and subscribe, and please have a great rest of your day.